The consideration by the U.S. government to potentially ban Wall Street hedge funds from acquiring homes and compel them to divest their entire portfolios could have significant repercussions on the real estate market. If such a measure were to materialize, neighborhoods like the one depicted might experience a substantial decline in home prices. The rationale behind this concern lies in the fact that these investors have played a pivotal role in both reducing housing inventory and driving up prices. Before going over the latest data, we ask that you please subscribe with your notifications turned on and leave us a like below this video. Data from Redin indicates a notable surge in investor activity during the pandemic, particularly in cities like Las Vegas. In some instances, investors acquired over 30% of homes in Las Vegas and nearly 40% in specific zip codes. The proposed legislation, known as the End Hedge Fund Control of American Homes Act, mandates hedge funds to sell off their real estate portfolios over a 10-year period. Failure to comply would result in a 50% tax on the portfolio's value. While the potential impact on home prices is a valid concern, it's essential to recognize that investors, including Wall Street entities, have already been reducing their presence in the housing market. In Las Vegas, for instance, investor purchases have declined by 65% from their pandemic peak, reaching the lowest levels in the past 5 or 6 years. The selling trend among these investors may already be underway, albeit gradually and in various markets. An example is observed in Henderson, Nevada, where American Homes for Rent, one of the largest landlords in the U.S., is selling a property acquired in 2012 for $17,000 and currently listed for $530,000. Despite the potential for a gradual sell-off, it's crucial to note that the overall impact on the entire housing market might be limited. Investors, including hedge funds, own approximately 574,000 homes in the U.S., representing only 0.6% of the total housing stock. Although the proposed legislation aims to address the behavior of large Wall Street investors, it falls short in addressing the broader issue of investor demand in the housing market. There are 27 million investor-owned properties in America, with hedge funds accounting for about 3% of them. To address the fundamental problem, considerations could extend beyond targeting specific types of investors and instead focus on reforming tax policies that incentivize real estate ownership, affecting both large and small investors alike. The current tax policy allows real estate investors to write off the depreciation of a property's structure, resulting in potential annual tax savings. For instance, if a house is purchased for $400,000 with a structure valued at $200,000, an investor could potentially write off around $6,000 annually. This tax benefit has led some wealthy yet smaller-scale real estate investors to acquire properties and leave them vacant, leveraging the tax write-off. Removing this tax write-off, particularly the depreciation benefit for owning real estate, could prompt both large and small investors to sell their properties. This change could have a significant impact on various housing markets, not just those where Wall Street investors concentrated their purchases. Interestingly, even in the depicted neighborhood, there's evidence of a house purchased by a Wall Street investor, namely Invitation Homes, the largest Wall Street landlord in the U.S., with over 880,000 homes. A townhouse, bought for $395,000 in April 2022, has seen a decline in value to $367,000. The investor's equity has dropped by about $30,000, reflecting a loss. Delving further into the property's history reveals attempts to rent it out for $2,300 initially, but the rent had to be reduced to below $1,700. This mirrors a broader trend in Las Vegas, where rents are decreasing in various neighborhoods, leading Wall Street investors to cut rental prices. The inevitability of this sell-off, in our opinion, may stem from the challenges investors face in managing declining rents amidst rising mortgage rates, with the 30-year fixed mortgage rate at 7%, equivalent to their cost of debt, and the 10-year Treasury yields over 4%. These investors are navigating an environment where government bonds return similar annual cash flow as rental properties in Vegas. The rise in interest rates might have signaled the end of the hedge fund's house-buying business model. However, It's crucial to note that the potential impact of this legislation and the ensuing sell-off is limited to specific cities and neighborhoods. Cities like Vegas, Phoenix, and Atlanta, where investors heavily invested, could experience more pronounced effects. For instance, Atlanta saw substantial investor activity during the last housing downturn, with certain ZIP codes witnessing a 50% decline in home prices. Investors acquired properties at lower prices and subsequently rented them out, contributing to the dynamics of those local markets. According to Redin, during the peak of the investor buying spree in 2021 and 2022, investors were acquiring nearly 35% of the houses in the Atlanta metro area. This concentration was particularly evident in the southern end of the metro, where, notably, in some lower-income areas of Atlanta, investors were buying up to 50% of the homes. An aspect of investor home buying that often goes unnoticed is their tendency to target lower-income neighborhoods. The rationale behind this strategy is that home prices in these areas are generally more affordable, allowing investors to potentially achieve higher yields and returns. Unfortunately, this approach has had the unintended consequence of exacerbating housing affordability challenges in already struggling communities. Over the last decade, investors have focused on areas where residents were already grappling with the affordability of rent and mortgage payments. By purchasing homes in these neighborhoods, investors not only drove up prices, but also created a situation where a potential sell-off could have more pronounced effects. While the U.S. government aims to prevent a major crash in prices through legislation, allowing investors a 10-year timeline to reduce their portfolios, there's a likelihood that some investors, especially those in affected neighborhoods, may attempt to sell off their properties sooner, potentially front-running the mandated timeframe. The impact of this legislation extends beyond Atlanta to cities like Jacksonville, where investors, particularly on the west side, acquired up to 50% of all homes at the peak of the market during the pandemic. This trend was particularly prominent in low-income and high-poverty areas. However, the fate of this legislation remains uncertain. Introduced in Congress a few days ago by Democrats, it has yet to face significant opposition. While some Republicans may express concerns about government intervention, the overall political landscape regarding the legislation remains to be seen. The prospect of government intervention in the housing market to regulate who can buy homes has sparked debates about the potential consequences of such regulation. In this case, the proposed legislation targeting Wall Street hedge funds raises questions about the impact it might have on the real estate landscape. However, I must admit that this form of regulation seems to carry fewer potential negative consequences compared to other regulatory measures. While some investors, particularly Wall Street hedge funds, may explore creative ways to navigate these regulations, such as involving third-party entities to make purchases on their behalf, the general sentiment is that not many people would be disappointed to see these Wall Street entities exit the housing market. The potential ban on their home buying activities might lead to some attempts to circumvent the rules, but overall, the public appears supportive of this regulatory move. Whether this legislation becomes a reality remains uncertain, as the stock market's reaction and the potential consequences are still unfolding. It will be interesting to see if this legislation gains traction and becomes a substantial regulatory change, or if it remains more of a symbolic gesture by Congress.